Oliver Bedford co-manages Hargreave Hale's AIM VCTs with Giles Hargreave. Thanks for taking the time to join us, Oliver.
Thank you.
You run two VCTs. What's the main benefit in terms of tax for investors using this as an investment vehicle?
Well, VCTs benefit from a series of very generous tax reliefs that include up to 30% income tax relief, tax-free dividends, and if they're sold at a profit, the shares are exempt from any capital gains tax. So what we say to people looking at our VCTs is what we're trying to create, if you like, is a portfolio of small companies, much like you would have in a unit trust or an OI, but in this case through a very tax-efficient structure.
Now, I understand that your AIM VCTs have beaten both the FTSE 100 and the AIM indices. Could you tell me a little bit more about that?
Over 5 years, VCT1 has returned about 50%, excluding the tax relief, and VCT2 is a little less than that, about 30%. As to why we've done it, I think probably just because we've tended to sort of focus in on the companies that we're investing in as opposed to the bigger picture, the bigger markets. And particularly now when we're in a slightly volatile market, we always review what we're doing and we come to the conclusion that ultimately all we can do to influence events is to make sure we invest in good quality small companies. And although there is of course companies within the portfolio that are exposed to the macro picture, on the whole what you're doing is choosing companies who've got their own unique little growth stories, and they will continue irrespective of whether or not the UK is growing at 2.8% or 3%, or whether or not Europe is growing at 1.5%. You're backing good companies with interesting growth prospects in front of them.
And most of your stocks are on the AIM market. What's the median market cap size for those?
Well, I think as the portfolios get increasingly mature, and the first VCT's been going for about 10 years now, then obviously what we hope is that what were some quite small companies 10 years ago now becoming significantly larger. The effect of that is in VCT1, the weighted average market cap is about £120 million at the moment. The average company in that portfolio has about 6 million of profit before tax and just under £4 million of net cash on the balance sheet.
And in terms of the number of stocks that you're running at any one time, it must be quite a large portfolio.
VCT1 has about 60 qualifying investments and VCT2 is probably about 54 at the moment. We expect that number to increase with time. Certainly here we're great believers in diversification. It's worked very well for us in the Marlborough funds, and we will continue to try and move towards a more broadly spread portfolio with time. Obviously in the case of VCTs, we can only buy shares when they're initially issued by the companies, so we have to be patient in building that portfolio.
So how do you manage the risks inherent in investing in small cap stocks?
I mean, I think our approach to risk management has evolved over time insofar as the VCT is concerned, because I think what we realised a few years ago is that your typical VC investor is looking for a slightly different profile to those that come into the Marlborough funds, although we may have common investors in both structures. I think in the case of VCTs, and you can see that from the way that investor money has flowed into generalists and planned exit VCTs and renewables over the years, is that on the whole people are looking for perhaps a slightly lower or reduced risk profile, and perhaps will accept a lower rate of return as compensation for that. And so what we've done with the VCTs is to try and move towards a less volatile portfolio as expressed through the net asset value of the company by focusing in on established, mature, stable companies, perhaps with, or we hope with, experienced management teams, which is why, as I said earlier on, it's important to grow these funds incrementally rather than too quickly.
In terms of the criteria that you look for in a potential investment, you mentioned management. How important is that, and what are the other main criteria that you'd look for in a potential investment?
Well, I think it goes back to your earlier question also about AIM. This is a portfolio that invests on AIM, and of course we understand that for some people that raises concerns, arguably legitimate concerns. But I think what we think is that really the characters that define a good company, the strength of its management team, its balance sheet, its business model, intellectual property, these are all characteristics of any company. It doesn't matter if it's on AIM or if it's on the official list or if it's a private company. So we try and hone in on those factors. But insofar as management team is concerned, it is the case that proven management teams tend to go on and deliver. And we've certainly got a number of investments where we've backed management teams in previous life, and then they've come back to the market subsequently advanced computer software is a good example. Vin Maria, her first business, Computer Software Group, was something that we owned through the Marlborough funds. It was a very successful investment. She exited to private equity, and then she came back to the market with advanced computer software in 2008. And that company is now subject to a bid, which is likely to go through, which will bring through investor returns around about 8x on the original in price. So she's a fantastic operator, very experienced, very knowledgeable lady, and hopefully this won't be the last we see of her on the public markets.
And could you tell me about a couple of other stocks that you've recently invested in?
Yeah, I mean, there's sort of two very different examples probably we could mention. The first of those is a company called Ideagen. It's a company we've known for a few years now, and they recently raised some more money to pursue an acquisition. Market cap for the company is around about £60 million. It has about 22 million of revenue. It should make about 6 million profit in the year to April 2016. The company does a range of governance, risk and compliance solutions for complex manufacturing, for healthcare, banking, finance. It also has content and clinic solutions for healthcare organisations. So its clients range from the National Health Service through to BAE Systems and various companies in between.
Are you always investing in companies that are generating profits, or do you sometimes invest in loss-making companies that have potential to make profits in the near term?
Yeah, no, I think it's a good question. I mean, a good company is not necessarily a profitable company. Clearly, there's a balance to be had between racking up heavy losses and placing shareholders' capital at risk and wanting to pursue growth. And sort of an interesting example, a very speculative investment we've recently made is Gfinity. Gfinity is in the world of esports, or gaming as you and I may know it. What it does is it takes well-known games such as Call of Duty or FIFA, and it creates competitions and leagues for people to participate in it. Now, what they do is essentially they create the structure for which people can play in, so they do all the administration, they create the rules, and they provide umpires as well, so when people play against one another, they can be sure that they're not being cheated against, if you like. It's a rapidly growing area. It's really interesting. Their most recent event they ran attracted 8.7 million online viewers. So it's a real growth area. It's not something that we know particularly well or understand, and I think it's still very, very early stage. The business model is still being sort of designed, if you like. I mean, people understand that they're going to hopefully be broadcast fees that the events will attract. Certainly a lot of people turn up and watch these events, and also I'd imagine there'll be advertising that will come in down the stream as well, but it's early days. So an area of huge interest and a very popular avenue for people, but not one that's well understood at the moment, certainly not well understood in the stock market.
That brings to mind, really, how do you keep on top of such fast-moving markets in terms of understanding the businesses? One day you might be dealing with a metal basher, the next it's some technology that's only just taking off.
I think we're very lucky here in that we have a very large team of managers. So there are about 10 managers and 3 junior assistants, if you like. And that enables us to keep tabs on a wide variety of companies. The last time I looked, we had seen 1,000 companies, or 1,000 companies had come in to see us in a 12-month period to September. So reach into the market is important, and then also experience. We've been doing this for a very long time. And that means that most companies come through to us, we've seen them before, or the management team, or something similar, either competition or perhaps their customers or their suppliers. So it's rarely something comes through that we can't get a handle on relatively quickly.
What are the most important lessons that you've learned working with Giles Hargreave, who's got an outstanding reputation as a fund manager?
I think probably that you should judge every company on its own merits, not to go into a meeting with any preconceptions. That's certainly been an important lesson. Also, the power of the team. I think that's been really, really true for us over the years, that it's very clear to us, at least through the performance of Giles's Marlborough Special Situations Fund, that diversified portfolios work very well for small companies. The reason being there's a real asymmetry between the risk and the reward of a small company investment. So obviously you can lose 100% in a worst case scenario, but also you can make 1,000% in the best case scenarios. And what we try to do is to manage the risk within the portfolio through these small allocations, through very spread portfolios. Perhaps one or two other things. Certainly, I suppose you could say that leopards don't change their spots. So good management teams tend to remain good management teams, and the other way around as well. Right. So successful companies are successful for a reason. And equally, when they go wrong, it's quite often the case that once a company starts to go wrong, it continues to go wrong. So we're not keen on averaging down, or if you like, putting good money in after bad money.
Lastly, do you have any advice for private investors?
Our experience is diversification is key in small companies. Right. Everyone appreciates they're risky. Everyone appreciates that the returns can be material. The point is that the potential for a black swan event is quite high, and the outcome can be pretty horrendous in terms of the performance of that investment. And these things happen for any number of reasons. They can happen because competition emerges, or perhaps the intellectual property is not as robust as you thought, or the management team isn't as strong as you'd hoped, or accidents happen. I mean, and that does, and we've seen that a number of times. The problem is in small companies, they're not so resilient as bigger companies, and so the knock-on effect can be pretty large. They don't have necessarily as much management in resource in depth. The founder can be critical to the growth story, and if for whatever reason he's unable to continue in his role, then it's not necessarily the case that his fellow board members have the same understanding of the market, or the same passion, or the same drive, or the same commercial ability. So sometimes these companies they fail several years down the road. So in terms of small cap investment, I think there's a lot to be said for going through a fund, unless that investor is particularly well resourced, because you're going to gain access to a very experienced fund manager, someone like Giles or one of his peers, who have great reach into the market, they have huge experience, and they can generate good returns. I mean, if you've been in Giles's fund from the start, the return is around about 1,800% over an 18-year period. He's compounded it at about 20% a year. I mean, that's a fantastic return for people. Of course, it's risky, but I suppose one of the other bits of advice for small cap investors is you have to make these investments on the medium and long-term basis. The market ebbs and flows. People can sort of feel more risk tolerant or more risk averse, and that can affect sentiment. And what you have to do is just understand that with a small company that's rapidly growing, or growing at a reasonable rate, that you have to give the management team time to grow that company and to adjust to the market as it adjusts around them. And if you do that, and it's a good company, then that can lead to really generous returns over time. But it's not always the case that those emerge too quickly. And if you do get good gains early on, it's very often a good idea to lock some profit in, because, at least in my experience, companies that go up rapidly in short periods of time can quite often retrace. I think I said earlier on, never be afraid to cut your losses if a company's not working out. At the same time, it's always not necessarily a bad thing to take some profit along the way.
But you're not afraid to sell it once you've formed the opinion that it's going wrong? Because that seems to be the hardest discipline for an investor, really, is to sell the underperforming stocks. You tend to hold on to them too long.
Yeah, I mean, and getting back to your earlier question about lessons you learn from Giles, one is not to be too proud to sell your stocks, not to fall in love with a company. So yes, I mean, when they go wrong, it's quite often the case it's good to get out, not to, if you like, deny the truth. But equally, I think one has to understand why a company's gone wrong. Sometimes mistakes have happened for reasons which doesn't necessarily mean that the company is a bad company, and it is sometimes the case that you should stick with it and wait for the company's fortune to turn around. And I can think of a number of companies like that. Any
particular one that you'd care to name?
Yeah, I mean, Cohort is a good example. We've been investing in it for about 9 years now. When it floated, it had a very experienced board behind it, including the chairman, a chap called Nick Prest, who was formerly chief executive of Alvis. And we very much like the story in terms of providing a top co which would enable other small defence niche technology companies to, if you like, gain access to the public markets, which help them with access to capital and cash flow, and also with the credibility of being a PLC. Might help them in customer negotiations and closing contracts. And that was a very good, solid, secure investment. In fact, for a long time, we often referred to it as probably our most reliable, most solid growth company across all our portfolios here. And then unfortunately they had a profit warning in 2008-9. And what was interesting with this case is that the management team, who we never really lost faith in, they went away, they looked at the issues, identified the problems, and they resolved it. And actually what we then did is we bought more shares in the company at a distressed price. Well, it was very clear to us that there was some deep value in the company, which was not being reflected by the stock market. And actually what has happened is the company's returned to growth and been hugely successful subsequently. The shares have probably gone up just over 3x from the bottom that they achieved at the time.
Thanks very much. It's been a fascinating interview, and I'm sure our viewers will get a lot from it. Thank you.
Thank you, Chris.